It's time to catch up with the wonderful team from the Canny Group. Chris Canny-Smith is joining us today in the studio. Hi, Chris.
Hi, Roxy.
Now, lovely to have you here. We're going to talk about something that a lot of people don't like talking about, but it's important to talk about.
That's right. And it's tax on deceased estates and inheritances. So a lot of people worry about it. I often have people ringing and saying, I'm inheriting some money. Will I have to pay tax? So the good news is no, you don't. If you inherit cash, there's no tax on it.
Oh, that's awesome.
It is awesome. You just have to pay tax on the interest you earn on it.
Okay.
So that's fine.
So but basically that's income. So that's a different thing, isn't it? So if you're getting income from that money, then that's taxable, of course.
Yep. And the same applies if you're inheriting shares. Again, you only pay tax when you actually sell the shares. So if you inherit shares, you don't have to worry about paying any tax then. You just have to make sure you keep some really good records so that when you sell,
so
you
that
can
when
pay.
you inherit those shares, you know what the value of them is at that point.
Yes.
Would that be right?
Well, yeah.
And then whatever is earned on those shares over and above that.
So it actually depends. If the person bought shares before the introduction of capital gains tax, then it's the value of the shares at the date they died, which is very easy to work out.
Yep. That'd be on the record, yes.
Yeah, but if they bought it after the introduction of capital gains tax, so after 1985, then it's what they paid for it. So sometimes you might have to go through that person's records or ask their executor if you can have the cost base, how much they paid for those shares.
Yeah, okay. So that could get a little bit complicated, couldn't it?
It does. So, yeah, that's when record keeping's pretty important.
What about like me? I've got some shares and Myer, they're about to close a few stores because they're not doing so well. If I croaked, would they get, my kids would earn money from having those shares, surely.
Well, if your kids inherited them, they would then only have to pay tax when they eventually sell them if they've gone up in value.
No, they haven't.
So
not since the day I bought them have they gone anywhere. They've just kept going down.
Oh, no, that's a shame.
And then I keep thinking, do I just keep them in the hope that Maya is going to do something amazing? And then, no.
So sometimes what you can do is sell them in the same year that you sell something that's made a gain so that the loss can offset the gain. So your accountant, that's something accountants can help with.
Because you know what? I just sit them there and don't even think about them, and I get my $32 a year or whatever it is that I get from whatever. What's that, the dividend?
Yes, the dividends, yes. So, yes, you could look at selling them, getting
maybe
your
that's
loss,
it. That
and then
is
get a gain on something
that's an
else.
awesome idea. So, kids, you're not going to inherit that worry. Don't worry about it. So, if I receive money, do I have to declare that in any way?
Only if you're getting some Centrelink benefits.
Okay.
So if you're on a pension or New Start or anything like that, yes, you have to declare it to Centrelink, not to the tax office. They're really not interested.
Yeah, sure.
And then there is sometimes tax to be paid by the deceased estate. Mm-hmm. So the executors will do a final tax return.
That'd be all done prior to the disbursement of the money or whatever.
So that's an issue for the executors. So if you're an executor of a estate, you need to be really careful. Make sure you've put aside money to pay tax. Make sure you've done the final tax returns. Mm-hmm. And that's something your lawyer and accountant will help you with.
This is where it's super important to have a really good accountant on board, I would think.
Absolutely.
And if you think about, Chris, a number of, many of your clients that you've had for a number of years, it would be just so easy. Well, not easy, but you've got all the records there.
Yes.
It would be very difficult if you didn't have somebody who was across the finances of that person.
Yeah, and a trap for executors is sometimes you think, I've brought in all the estate, here are the assets, we've sold them off, we divide it by the beneficiaries, pay everyone out, and that's all well and good, but then they do the tax return and find that the deceased actually might have a tax debt of $50,000. They might have had a rental property. They might have had various things, and so the executor is then liable for that. So
and very hard to find those relatives at that point after they've got their money, isn't it?
Yes, and that's why you make sure you cross everything off, tick all your
Yeah.
boxes before
All
you
right.
distribute it.
Yeah, trap for young players there. Look, my view, just find a really great accounting firm like the Canny Group who've also got legal on board.
Yes.
So you can take care of your whole will and
Whole
everything, the whole kit and caboodle, as we say, and then let them worry about it. Let Chris get some grey hairs.
Yes, I haven't got enough.
Yeah, that's right. Chris, it's been a delight having you in today. Thank you so much.
Thanks.
Look, I think that really has clarified things, and I think people would be very surprised about there being no tax on the money that you inherit.
Thank
All
you.
right, we will catch you again. The Canny Group, you can find them very easily online. Just either do a Google or it's the cannygroup.com.au. You can't really get any easier than that.